There's lots to talk about, so let's bring in our featured guest of the morning. He's Rob Wessel, managing partner at Hamilton ETFs, and of course a former Bay Street bank analyst himself. Rob, thanks for coming in.
Oh, thanks for having me.
Okay, let's talk about the results first of all, and then we'll get to the overhang on the stock, which is clearly the regulatory problems. What do you see in the numbers this morning?
Yeah, so the results were very messy. They had 8 one-time items, 1.2 billion after tax. So anytime you have that many one-time items, and I think it's the third consecutive quarter of restructuring charges, you know there's a lot going on at the bank. But having said that, the things that the analysts care about and the market cares about were broadly stronger than expected. So I think there's a good chance that you'll see the stock move higher today.
Well, let's bring back that board of the earnings per share, and we'll show you it's a sizable earnings beat. Is this a clean beat, Rob? Or
no,
it's not.
No,
okay.
It's not a clean beat. And in fairness to TD, no Canadian bank is reporting clean results in the last 3 quarters. So there's a lot of junk in the results. There's a lot of one-time items, and this quarter was very much indicative of that. In fact, it probably had more one-time items than you would generally expect. It was 8, which was a lot.
The bank in Canada reporting a 7% lift in profit to $1.7 billion, reflecting revenue growth, partially offset by higher provisions for credit losses. What does the credit loss picture look like at TD, and what are we expecting for the rest of the Canadian banks?
Well, it's a bit unusual. It was actually quite unusual, or a bit surprising, I think, that provisions against impaired loans actually went down. Yet at the same time, provisions against performing loans went up in a fairly notable amount. So all in all, it was a wash, but normally you wouldn't see that mix. So it was a bit different. And I think it's a little hard to read that, to take that and read through to the other banks.
In the U.S., the numbers, as I think viewers and investors would expect, were very much affected by the number that the bank, the amount of money that the bank set aside in anticipation of penalties from U.S. regulators on the money laundering issue. If we look past that, what does the performance in the U.S. look like?
Well, you can't really look past that, if I may. I mean, at the end of the day, TD is the lowest multiple bank right now. It hasn't been the lowest multiple bank for 20 years. So this is going to resolve itself in either of 2 ways. The market's going to get comfortable with the E and the bank's earnings capacity, and the stock will drift higher, but probably not back to a premium, but back to the average, we'll say. Or 2, the market, once it gets more information about what's going on in the United States, will readjust and have a more accurate estimate for the E, the earnings. So the U.S. bank is a third of earnings, and right now we don't really know what it can earn going forward because of this regulatory overhang. So if the E comes down, then the PE goes up, but the stock doesn't change. So right now, everything hinges on, in terms of if you want to buy TD Bank and you want to say, I feel good about this stock, you really need to wait until the regulator in the United States comes in, because it could be you really have to not worry about, but consider and contemplate and incorporate what this is going to mean to the future earnings of TD Bank USA. There could be higher expenses going forward. There might be a restriction of business activities.
Right.
And the other thing is just a giant distraction. So this is a third of the bank. So is the earnings for the third of the bank going to be relatively stable and grow with the U.S. economy, or is the earnings going to be readjusted based on this new regulatory framework and regulatory implications? We don't know that yet.
Often, it's been the case with that shares of U.S. banks rise on the day that a penalty is finally announced. It's been anticipated for a long time. A number gets disclosed. Investors seem to say, well, now we at least have certainty. We know how bad the penalty is, and quite often the stocks lift. This sounds like a different type of story.
Yeah,
though,
this
right?
is a bit more like Wells Fargo when they had the consent order. And I know obviously the analogy doesn't quite work, because the consent order was for the entire bank and it's only in the U.S. for the most part. This would be for the U.S. part. But still, I think that weighed on Wells Fargo stock for a very long time. And that consent order lasted, I think, 4 to 5 years. I can't remember the exact time, but it was an overhang for a long time. So this isn't where, like, you took a giant restructuring charge. The bank has lots of capital. Everybody can forget about it and move forward.
Right.
We really need to figure out, what is this going to do to the operating profitability? The business model of the U.S. bank for the next couple of years could be negatively impacted by all of this. And now, maybe not. We'll see. But certainly, the market's pricing in, some impairment of the earnings capacity going forward. And but it is, because it's such a large part of the bank, I think we have to wait. A
lot of analysts speculate that there may be a ban or a restriction on TD making acquisitions in the U.S. for an extended period of time. How damaging would that be?
It wouldn't be great. So, yeah, that wouldn't be great. Now, they're very big in the U.S., so I don't think that's like a deal breaker, or, that would necessarily take the bank to a severe discount for an ongoing basis. I think it's more, what's going to happen to the expense base, because there's going to be a lot more expenses, a lot more compliance expenses, and so does the efficiency ratio go up and profitability come down, and therefore the present value of future cash flows is lower. And that will, that's going to be fungible. It's going to be hard to know. You're going to have to wait and see how it all plays out. But, definitely a cap on acquisitions would be a negative, but they're large enough that I don't think it's going to be, a severe outcome.